Welcome back, Principles of Accounting 2 students. We are on part 2 of a never-ending budget problem for chapter 22. We last video we covered the sales budget and then also how to record your cash from your customers. As you can probably tell, and I did not notice before, I think I spelled receipt wrong. Maybe I didn't. No, who knows. All right, so let's go back up here. We're going to now cover the inventory purchases budget. Now we have our inventory purchases here, and all we're doing is recording the inventory that we need, how much we plan on using, and then our cash flow out. So in receipts, we looked at how much we're getting in from customers, and with purchases, we're actually buying stuff and the cash flows out. The cash flows in, the cash flows out. So then we have some data here. Well, let's get rid of that. Sorry. We have some data here. Here's your cost of goods sold as a percentage of sales. It can give you a cost of goods sold as anything. This particular company calculates their cost of goods sold based on the percentage of sales, which means if your total sales are $110,000, your cost of goods sold are going to be $60,000. This has nothing to do with cash or credit. You want to take your total sales. Here we have a desired ending inventory. So if you think about the 30th of the month, you want some inventory left over, especially if it takes 15 days for something to get in. And why do you want something left over at the end of the month? Because you want to cover sales that happen on the first day of the next month. If all your inventory comes in on the 15th, you need inventory in the beginning to basically carry you over. All right, December purchases. All right, so remember we're doing January, February, March. These are December purchases of $60,000. We have November purchases of $48,000. We'll probably need these, I'm thinking. December ending inventory of $19,800. And then we have a payment schedule here. This tells us once we buy something, when we plan on paying it. So here we're saying net 30. Within 30 days, we plan on paying half, which is a month, right? Within 60 days, you're going to pay another 40%. So 90% of your bills are paid in 60 days. And then you're going to pay your last 10% net 90. All right, fair enough. So let's go over here. We have our inventory purchases budget. And they're asking what our cost of goods sold is in January. We know cost of goods sold is 60% of sales. So what I do is I take my January total sales. Doesn't matter if it's cash or credit, because we still have to provide the customer with something. And we multiply it by 60%. I'm going to hit that little F4 thing to get the dollar signs. There's my formula. Enter. 66,000. Now here it does make sense to add these up, because on your income statement they're going to ask what your total cost of goods sold was. What we're saying is $364,000 in sales, $218,000, and stuff, was the cost of the sale. Right? The difference between those is gross profit. Yay, gross profit. All right, now here we want plus desired ending inventory. Okay, so our desired ending inventory is going to be 30% of the next month's cost of goods sold. All right, so in February, I want 30% of that. So I want $21,780 of inventory lying around at the end of the year. In February, I want 60%. Oh, I'm sorry, 30% of March's COGS sitting around at the end of the month. Now let me back up here. Total inventory needed. Think about this, right? Here's what I'm selling, right? I'm selling it and it's leaving the warehouse, so I need it if I'm going to sell it. And I want this left over. So what I'm selling plus what I want left over is what I need. Kind of makes sense a little bit, right? Here's what I'm selling. Here's what I want sitting around the warehouse. So I know I need that much. All right, what is March's ending inventory? Well, we need April's cost of goods sold. All right, so how do we do that? Well, we know that March's sales are 133,000, and we know from before that sales increase by 10% a month. So that gets us April's sales, and we know that cost of goods sold is 60% of that. So that gives us April's cost of goods sold. Follow me? And we know we want 30% of April's cost of goods sold left over, which gives us a weird looking number because it's not formatted right. But if I come up here and do this and this and this, notice it kind of makes sense, right? It's 21, 23, 26. I bet you the shortcut for that is just take that times 1.10. Yeah. So we could also think of it this way. If sales are going up 10% a year, month, cost of goods sold will go up 10% a month. So there's a couple different ways of calculating that. Either one will get you the same number. All right. So then what is, now here's where the total column gets messed up. Because it doesn't make sense to add 3 months of ending inventory and say that's our ending inventory. Right? What's our total ending inventory at the end of March is just that number. Because this inventory is gone, right? We sold it in March. This inventory got sold in February. At the end of the period, this is what we have lying around the warehouse. So if you do this wrong, you're overstating your inventory, and then you get in trouble. All right, total inventory needed. Again, yeah, I guess you could add these up, or you could just take that plus that, and these should give you the same numbers. And they don't. Cost of goods sold. Oh no, these actually won't give you the same numbers. Sorry, this one down here will. So what do we have? We have cost of goods sold plus desired ending inventory is going to equal 244,000. So that's how much inventory we need for the quarter. Minus beginning inventory. So December's ending inventory will be January's beginning inventory. Makes sense. January's ending inventory is February's beginning inventory. Remember, every new beginning is some other beginning's end. February's beginning inventory is March's beginning inventory. February's ending inventory is March's beginning inventory. And here they want our beginning inventory. Well, what was our beginning inventory? So you go all the way back to the period. So these 3 boxes are slightly different. You have to think about what they're asking here. Here we're asking for beginning inventory. Here we're asking for ending inventory. Okay. Now on this one, all right, what do we need? I need 87,000. I already have this, which means I need to buy 67,000. Here's what I need. Here's what I already have. Therefore, this is what I have to get. Very straightforward. This is the box here. I can either add these up and get 225,014, or I could just take that minus that and get the same number. So that should tie. So when this box here, get out of here, get out of here. When this box cross ties, cross-foots, I guess, may as well talk like an accountant. When that box cross-foots, you know you got it right. The homework really kind of drives that home pretty hard too, so you'll see a lot of that. One of the things too, this is a merchandising company. Let's go over here. If you were a manufacturing company, instead of an inventory purchases budget, and the book chapter does this well, you would see the production budget plus a materials budget, a labor budget, or an overhead budget. So if you make a product, you need all four of these budgets. If you're just buying it, you don't need any of those. So that's what makes this a little bit easier, a little more testable. It's actually kind of a travesty that the textbook starts you with the really complicated one first, and then the appendix buries the merchandising company. But that's what it is. But that would be the big difference between a merchandiser and a manufacturer, is you don't have to do these four budgets, which is nice. But on the other hand, these are all the same, right? It's like beginning materials minus what you need, what you have. You have all this junk. All right. Plus what you have at the end. Yeah, da, da, da. Cash payments to suppliers. So what we're saying here, and I actually wrote this down here. These numbers tie to these numbers here. So in January, what did I purchase? I purchased 67,840. No, 67,980. Wow, I was looking right at it, saying a different number, 50%. Now in February, you purchased 67,980, and you're paying 40% of it. In March, you purchased 67,980, and you're paying 10% of it. So these are your cash outflows based on your January purchases. It's like when you buy something with your credit card. Your parents will pay it off in January and February and March instead of all at once. All right. So then we have 40% of prior month's purchases. Oh, well, look at over here. Well, the month before January was December, and I have something for December here. So if I purchase $60,000 in December, and we're on month 2, which means in December we paid 50%, January we paid 40%. And we can do that again for February, right? I have $60,000 in February, December, January, February, 10%. All right, 10% off third month's purchase. So we have December, November. So we go November, December, January. So we're going to go equals November's purchases times, this is paid in November, December, January. So we have that taken care of. We can sum here, and that will give us the total cash outflows for cost of goods sold in January. All right, February, 50% of February's purchases. And here we have 40% of February's purchases that we're purchasing in March. And let's make that a little larger. I see what the problem is. Let's get rid of these decimals. Come on. All right. And in March's payments here, $82,000, we're paying 50% of it. All right. So now I can sum these up. This is how much we paid in February. This is how much I paid in March. Here it makes sense to total every single one of these columns. Here's how much money, cash, I paid. Luckily, this is how much money I received. So it looks like I'm receiving more than I'm paying, at least for inventory purchases. Okay. There we go. These don't make a ton of sense, but that's fine. This is really your key number here. All right, last thing we want to do here, we have something called a payable. If you remember from Principles 1, accounts payable are accounts that we have to pay. So we purchased $67,000, but it looks like we paid that off, so we don't owe anything on that for January. For February, though, we bought $74,778 worth of material. 40% of it we paid in February. 50% of it we paid in February, sorry. 40% of it we paid in March. We owe 10% of that still. So what we do is we take 774 times 10%, and we'll call that February purchases. And then we also bought some stuff in March that we haven't paid for yet, right? We bought $82,000 worth of stuff. We get rid of those decimals. Paid 41,000 of that, which means we still owe 50% of that. So a couple ways of doing it. We could just take this minus what we paid. And so we know our total AP is going to be these two numbers. That means if we don't buy another thing, we're going to owe $48,000 in cash payments over the month. It's your credit card balance, essentially. Okay, well, that is all I'm going to do on this video. The next video, we're going to do the selling and administrative budget. Hopefully you're having a good day. Take care.